Hey everyone, welcome to Alpha Insights. I'm Jordan.
And I'm Lucy. Thanks for joining us. And hey, if you have questions while you're listening, drop them at stockalpha.ai.
Today we're digging into a name that moved in the opposite direction of pretty much everything else during the recent Middle East headlines. POET Technologies.
Right. The market was on edge. Oil spiked above $110 a barrel, and broad indexes were sliding. But POET did something unusual.
Starting March 1st, the stock went from about $6 up to $8.27, roughly a 38% run, while the S&P 500 ETF was drifting from $690 to $629. The Nasdaq ETF was falling from $612.76 to $555.60, and Nvidia dropped from $187 to $162.
Exactly. So while most names were bleeding, this one was ripping higher. But then, sentiment flipped hard.
Over 91% of POET's free float is held by retail investors. When the headlines got scary, that group tends to act fast. The stock reversed from $8.27 down to $4.87, about a 41% slide from peak to trough in just weeks.
And that's where the volatility story really lives.
Mm-hmm.
I mean, when you look at the data, retail ownership explains both the drop and the rebound. That concentrated base sells quickly on fear, but it can buy back just as fast when a narrative reasserts itself.
Exactly. After the panic, a reported earnings beat and reminders of the commercial pipeline produced about a 17.7% snapback. By April 7th, the stock had clawed back to about $5.89, even while the broader indexes were still off their March highs.
History also gives us perspective. Analysts note that in the first few weeks of a geopolitical shock, stocks typically dip roughly 6%, then recover over the following few weeks. POET compressed that whole sequence into a single month.
So, the real question here is, was that original upward move driven by fundamentals or just momentum?
Good question. It wasn't purely random momentum. The company entered the period with more than $300 million in cash, a $5 million production order for optical engines, and new commercial partnerships with Lithion and Lessengers. They were also showing product momentum at OFC. Things like their optical interposer, Blazar, Starlight, and Terralight platforms were getting attention.
Those are all real business items. To unpack one of them quickly, an optical interposer is basically a way to integrate optical connections closer to chips for much faster data flow. For AI infrastructure, that matters.
Yeah, that's a good point.
But we should be careful. Nothing fundamental changed between the peak and the trough. What did change was the macro noise around the conflict and the resulting retail reaction.
On the macro side, there have been reports of a temporary ceasefire tied to reopening the Strait of Hormuz, which has acted as a cap on near-term escalation. Every hint of de-escalation has produced sharp intraday reversals across markets, showing there's a bid waiting on dips.
Analysts also point out that S&P 500 earnings growth looks resilient. Consensus estimates had first-quarter earnings growth near 13%, marking several quarters of double-digit gains. In short, the corporate earnings story hasn't broken even with the geopolitical noise.
So you've got a security with real product traction and cash on hand, owned mostly by retail, which creates exaggerated moves when headlines hit. That's a classic volatility profile.
Honestly, I was a bit surprised by how fast it moved both ways. The same ownership dynamic that drove a 38% rally also produced a 41% collapse. Then, with a bit of news, it bounced roughly 17.7%. It's wild.
Right. Now some analysts have put a near-term reference price around $7.25, and they point to the prior $8.27 peak as evidence the stock can reach those levels again. Assuming the macro noise continues to fade and the product story reasserts itself.
We should emphasize, that's market commentary, not advice. This is analysis about momentum and risk, not a buy or sell instruction. The risks remain real. Headline risk, oil price swings, and the fact that so much of the float is retail.
Short reactions?
Right.
Interesting.
So what should listeners watch next? First, any fresh headlines about the conflict. Those move oil and market sentiment quickly. Second, company-level news, production orders, partnership announcements, or updated conference showings that validate the product roadmap. Third, overall market breadth and earnings reports. If the broader risk rally resumes, that helps names like this.
And remember the ownership structure. When so much of the float is retail, expect faster swings, both up and down. That creates trading opportunities for some participants, but also heightened risk for others.
To wrap up then, 2 quick takeaways.
Yep, go ahead.
1. Poet's price action was driven heavily by retail sentiment and headline volatility, not by a sudden change in fundamentals.
2. The underlying business signs, cash, orders, partnerships, product momentum at trade shows, are still there. So analysts are watching for whether the market remembers that as headlines calm.
Got questions? We'd love to hear from you. Head over to stockalpha.ai, where you can ask us anything and we'll answer live. And while you're there, check out more market content and drop your questions in the Q&A.
Thanks for listening. We'll keep tracking how the macro picture and retail flows affect these kinds of stocks. And we'll bring updates right here on Alpha Insights.